Today's Wall Street Journal. We're breaking down the biggest business stories of the day, what happened, why it matters, and where the incentives really are. First article from Journal: Generals are hot commodity in mining. Mining companies are starting to look like defense contractors. That's not my line. That's the implicit message of a piece in the Wall Street Journal about how generals, actual four-star generals, admirals, senior officers, have become a hot commodity in mining. If you care about incentives, capital allocation, and long-term compounding, this should make your ears perk up. Because when a sector that's supposed to be about geology and ore bodies suddenly needs retired military brass on its boards, it tells you the game has changed. The value isn't just in the rocks anymore, it's in the relationship with the state. The central characters in this story are two types of people: the geologists and finance executives who traditionally run mining companies, and the retired American generals, colonels, and admirals who are now being brought in as guides through the less familiar terrain of Washington. On the mining side, you've got companies operating tungsten mines in Europe and South Korea, rare earth projects in places like Greenland, and antimony for bullet hardening here in the US. These are not glamour commodities. They're critical minerals in the language of defense policy. Inputs you need for weapons systems, electronics, and industrial capacity. On the military side, you've got people like retired four-star Army General Gustav Perna, a logistics expert. You've got retired Army Brigadier General Stephen Allen, now a chief operating officer. You've got retired four-star General Richard Myers sitting on the board of MP Materials, a rare earth miner. You've got another four-star, Jack Keane, on the board of United States Antimony. And then you've got a British Virgin Islands-based company, Critical Metals, putting a retired four-star general and a retired rear admiral onto an advisory board for its rare earth mine in Greenland. These are not honorary roles. These are paid positions, tens of thousands to hundreds of thousands of dollars a year. In one concrete example, General Myers collected $240,000 in 2004 from MP Materials in fees and stock awards. That's real money. But more importantly, it's a signal. The company believes the value he can unlock in Washington is worth multiples of that compensation. So what changed? Why do miners suddenly need generals? For a long time, what worked in mining was fairly straightforward. Find a deposit, secure the rights, raise capital, build and operate the mine, navigate local politics and environmental rules, sell into global markets. The geopolitical layer was always there in the background, particularly for oil and gas. But for many metals, you could largely rely on global trade to do its job. The cheapest, best-run projects anywhere in the world would eventually find their way into the supply chains of manufacturers and governments. That quietly broke when China weaponized its position in key minerals. The article points out that China cut the US off for much of last year from some of these critical inputs. In response, the Pentagon started shelling out billions of dollars to rebuild domestic supply chains. That's the inflection point. The locus of control over who gets funded, which projects move forward, and which mines actually matter shifted from commodity traders and industrial buyers to the U.S. Department of Defense. If you run a mining company that touches critical minerals today, your addressable market is no longer just whoever will buy at LME price plus. It's Washington. It's the Defense Department. It's allies' procurement programs. Your success depends not only on the ore body and your cost curve, but on your ability to plug into a national security agenda. That's why generals are suddenly part of the org chart. The Journal article spells out what they do. They guide mining executives, geologists, CFOs, CEOs through Washington's less familiar terrain. They make introductions to big defense contractors. They scrutinize business deals with foreign partners to make sure those deals won't raise red flags at the Pentagon. They advise on who to meet on Capitol Hill. In other words, they translate between two worlds, the world of rocks and the world of rules. From a founder/owner lens, this is a radical expansion of the skill stack that matters. It's no longer enough to be able to build a technically sound mine with acceptable economics. You have to be able to design a capital allocation strategy that fits inside a Defense Department supply chain map. Look at Almonty Industries, one of the companies highlighted. Almonty is a North American company mining tungsten in Europe and South Korea. Tungsten is used in armor-piercing munitions, tools, and high-temperature applications. It's strategic. Last year, Almonty put two retired American generals on the team, General Perna on the board, and General Allen as Chief Operating Officer. On screen right now, you're seeing their photograph. Two men in business attire, not uniforms, standing together. The caption makes it explicit. Retired four-star Army General Gustav Perna and retired Army Brigadier General Stephen Allen play roles at Almonte Industries. That image matters. It's visual proof that this isn't theoretical. These are not advisors tucked away in a PowerPoint. They are front and center faces of the company. Think through the decision autopsy here. What was expected in the old model? A mining company would seek capital from markets or strategic partners, do its permitting, build the project, and then sell its output into relatively open global markets. Maybe you hired lobbyists or consultants in DC if you were big enough, but generals? That was rare. What actually happened? China weaponized its dominance in key materials, cutting off U.S. supply for much of a year. The Defense Department responded by paying billions to rebuild domestic and allied supply chains. The funding gate moved from capital markets alone to a blend of markets plus government. And those gates are guarded by people and institutions steeped in military culture, security reviews, and political sensitivities. The opportunity cost for the mining companies is clear. Every dollar an hour they spend chasing Pentagon grants, structuring deals to pass Fuse-style scrutiny, and hiring generals is $1 an hour not spent on pure operational improvement. But the hidden trade-off is even bigger. If you don't adapt to this new reality, you might never get your project funded or approved at all. For the generals, the incentives are also clear. After decades of public service, they step into board roles that can pay tens or hundreds of thousands a year. They leverage their networks, their understanding of procurement and logistics, and their credibility with defense officials. From a system-level point of view, this is the Defense Department effectively outsourcing part of its industrial policy execution to retired officers embedded in private companies. That's not necessarily bad, but it blurs lines. Are these companies optimizing for shareholder value, for national security, or for maximizing access to DoD dollars? You can see the same pattern in the other names the article drops. United States Antimony, a company whose metal is used to harden bullets, went on a search that stretched for longer than a year to find the right former military official for its board. The result, retired four-star Army General Jack Keane joins in August. That's a long recruiting process to fill one board seat. They weren't just looking for any independent director. They were looking for someone with the right mix of access and legitimacy. Critical Metals, the British Virgin Islands-based company developing a rare earth mine in Greenland, didn't stop at one retired officer. It appointed both a four-star general and a rear admiral to an advisory board. That's two high-ranking signaling mechanisms in one stroke. They're not just telling investors we're serious about this. They're telling the Pentagon, we speak your language. MP Materials, a more visible rare earth miner, has General Myers on its board, collecting $240,000 in a year from fees and stock. That's a number you should anchor on. It tells you the market rate for reputational access at that level. It also gives you a sense of how much these companies think a general's presence can move the needle in terms of grant approvals, contract awards, or regulatory green lights. Now, let's step into the reality check. The journal is very clear. Western miners have added at least a dozen former American generals, colonels, and admirals to boards or senior roles over the past year alone. That's a trend, not a one-off. On one hand, this is rational. The Defense Department is spending billions of dollars to rebuild domestic supply chains after being cut off by China. To access that pool, you need to understand how DoD thinks, how acquisition processes work, and how to avoid getting disqualified over some badly structured foreign partnership. If you're a CEO or CFO who grew up in geology and finance, not in Pentagon hallways, you are out of your depth on that terrain. Hiring a general is buying a guide. On the other hand, it raises hard questions about business quality. The more your returns are driven by political allocations rather than competitive advantage, the more fragile your compounding becomes. A project that only works because of a Defense Department subsidy is a different animal than one that works at market rates. If the political winds shift, if budgets get cut, if priorities change, your moat can vanish with a pen stroke. Generals on your board don't fix a bad ore body. They don't fix a high-cost structure. They don't fix poor execution. They can help you win the race to build the mine. They can't make the mine inherently attractive once it's built. There's also concentration risk. When multiple critical minerals companies are all drawing from the same pool of high-ranking retired officers, your differentiation may shrink. If every serious player can field a former four-star on its masthead, the marginal edge of one more general declines. What starts as a competitive advantage becomes table stakes. Costs go up as everyone bids for the same scarce brand names in the military community. From a long-term owner's perspective, you want to see that these relationships are being used to align with durable strategic positions, not to paper over weak fundamentals. If a tungsten mine in South Korea and Europe, like Almonte's, has solid geology, reasonable costs, and good local relationships, then leveraging a logistics expert like Perna and an operations-minded general like Allen can be additive. Better planning, better coordination with allied supply chains, smoother DoD interactions. But if a project is marginal on its own merits, and the entire equity story rests on, "We've got a general, we'll get defense money," that's a red flag. That's success. Political access, being carried too far to the point where it becomes the crutch. 3 lessons stand out from this Wall Street Journal story. First, incentives shape the industrial base faster than geology does. China's decision to cut off the U.S. for much of a year forced the Pentagon's hand. Billions in defense dollars began flowing into domestic supply chain rebuilding. The incentive for miners flipped. Instead of just chasing the highest commodity price globally, they now chase strategic status in Washington. That's why generals are on boards. They're there to align the company with the new incentive map. Second, scale becomes a disadvantage if it's all political. If your ability to secure capital and contracts depends heavily on your relationship to the state, then the biggest players, with the most decorated boards, will vacuum up the lion's share of support. Smaller but technically superior projects may get sidelined. Over time, that can produce a bloated, politically connected industry with misallocated capital. Factories of concrete and steel that exist because they were strategic, not because they were the best use of resources. Third, success plants the seeds of failure when you confuse government-driven growth with durable competitive advantage. Right now, hiring generals looks like success. Stocks spike on announcements. Investors see alignment with the Pentagon. Projects move faster through the bureaucratic maze. That feels like a moat. But if the underlying economics of the mine are weak, and if the only thing standing between you and irrelevance is the favor of a few people in Washington, then the seed of failure is already planted. So what's the core question this article is really asking? It isn't simply, why are generals going into mining? It's, are these retired officers helping to build a genuinely resilient, economically sound critical minerals ecosystem? Or are they being used as expensive access badges in a political scramble that leaves the fundamentals unchanged? As a long-term owner, you want to own the companies that use this moment wisely, that bring in military expertise to strengthen logistics, governance, and alignment with national priorities, while still insisting that every project makes sense on its own economic terms. Because the line that should stick with you is this: the miners that will still matter in 20 years are the ones that treat generals as guides to good projects, not as a substitute for having good projects in the first place. Moving to next title, Hyundai CEO bets on U.S. robots. Hyundai's stock is up 80% in a month because it showed off a humanoid robot. Just sit with that for a second. Not because robots aren't important, but because a century-old car maker, built on metal and engines and assembly lines, is now being rewarded by the market for looking like a tech and robotics platform. This story is from the Wall Street Journal, and underneath the headlines about tariffs and robots, it's really about one person, Jose Munoz, and one question: can a foreign, non-founder CEO reshape a Korean industrial dynasty fast enough to survive the next decade of compounding? If the job of a car executive is to sell cars, the article points out it's hard to argue with Munoz's results. Last year, Hyundai sold about 1 million vehicles in the U.S., 39% more than when he joined in 2019, and more than 4 million worldwide. That is serious execution. But the piece also makes something else clear. Munoz is not satisfied. In his own words, he thinks Hyundai is moving too slowly in an era of tariffs and technological change. His instinct is to accelerate, to shake up culture, to bet hard on robots, flying cars, AI chip partnerships, and to push a dual-track strategy in the US and China that looks nothing like the one-size-fits-all car business of the past. Let's start with who this guy actually is. Jose Munoz is the first non-Korean chief executive of Hyundai Motor. Not just of Hyundai the brand, but of any company among South Korea's top 30 business groups. In a chaebol system dominated by family and insiders, he is an outsider at the very top of the org chart. His background is not what you'd expect. He has a PhD in nuclear engineering. He worked in Spain's nuclear energy sector in the 1980s. Back then, he didn't even own a car. Only after repeatedly missing the last train home in Madrid did he buy one introduced by a friendly car saleswoman who later became his wife. She was the one who nudged him into the auto industry. From there, he did time at Daewoo Motors, then at Nissan as a top lieutenant to Carlos Ghosn. In 2019, he joined Hyundai as Global Chief Operating Officer, overseeing U.S. sales. His success in the U.S. with models like the Tucson SUV and a run of design and quality awards earned him the promotion to CEO of Hyundai Motor. But the article is explicit. The ultimate decision-maker is still Yuisun Chung, the executive chair of Hyundai Motor Group and grandson of the founder. So Munoz is the operator, not the owner. He is the builder executing within someone else's capital allocation framework. That distinction matters. He can push, he can shape, he can accelerate, but there is a family system above him with its own incentives and history. For a long time, what worked for Hyundai was pretty straightforward. You built reliable, value-for-money cars. You climbed from budget positioning to respectable mainstream. You leveraged cost advantages in Korea and later in other plants to undercut rivals on price. In the US, you slowly won share with strong warranties and improving quality. Globally, as the article notes, the Hyundai-Kia duo climbed to third place after Toyota and Volkswagen. In the American market, they now control about 10%, behind only GM, Toyota, and Ford. That model, good product, better price, compounded for years. What quietly stopped working, or at least started to crack, was the assumption that the rules of the game were stable. Two big external shocks hit the system. First, in 2025, President Trump's tariffs on imported cars like Korean-made Hyundais bit hard. Hyundai's net income for the year fell 22%, even though global revenue hit a record. Think about that. Record revenue, big profit drop. That's margin compression via policy. Then, just 3 months after the US and South Korea agreed to lower US tariffs on South Korean imports from 25% to 15%, Trump threatens to restore the 25% rate. In other words, the political environment is not just hostile, it's unpredictable. Second, technology. The electric vehicle transition has not followed a smooth narrative. Adoption has been uneven. Infrastructure is patchy. Consumer preferences are split. The article quotes Munoz describing a dual-track policy. In the US, slow the transition to fully electric vehicles and double the number of hybrid models to more than 18 by 2030. In China, where he now goes to learn rather than to teach, plans some 20 new EV models. The old model of building a global platform and rolling it out everywhere is done. Now you run a complex options portfolio. Hybrids here, EVs there, different speeds in different markets. That's capital allocation under uncertainty, not just product planning. Overlay on top of that a third force: ambition. Munoz doesn't just want to run a car company, he wants Hyundai to become a tech company, mobility company, that happens to sell cars. That's where the robots come in. On screen right now, you're seeing a Hyundai studio in a suburb of Seoul. Luxury vehicles are parked on a showroom floor. Among them roams a yellow robot dog named Spot, designed for work sites. The article notes that Hyundai bought a controlling stake in Boston Dynamics in 2021. This is the company famous for its viral robot videos and has deepened its push into robotics since then. Spot is physical proof of that. More dramatic is Atlas, the humanoid robot Hyundai showed off at a Las Vegas trade show in January. The article describes Atlas as able to twist its head, torso, and joints 360 degrees and to replace its own batteries at a charging station. These are not toy robots. These are industrial machines intended for real work. Hyundai plans to deploy Atlas robots in its Metaplant facilities in Georgia from 2028. That's not just about cool demos. It's about how future factories are going to look. Human workers alongside autonomous, battery-swapping humanoids, all orchestrated by an AI layer. And there is an AI layer. Hyundai has a partnership with NVIDIA, one of the leaders in AI chips. The company plans to use 50,000 Blackwell chips to make its manufacturing smarter and to bring real-time AI functions into its vehicles and robots. 50,000 chips is a big number. That's not a pilot, that's a platform. Each chip represents CapEx, integration complexity, and an assumption that AI-driven optimization will pay off over time, in yield, in quality, in new features. From a value investing lens, this is where you start asking the capital allocation questions. What was expected when Hyundai was just a car company? You built plants, you tooled lines, you amortized investment over millions of vehicles, you managed model cycles and incremental engineering improvements. What's actually happening now is much more layered. The company is committing roughly $26 billion to invest in the US. It is accelerating factory build-outs in an environment where tariffs, immigration enforcement, and local politics are all volatile. It is simultaneously buying a robotics company, loading up on AI chips, and betting that 70–80% of its US sales will be American-made cars by 2030, up from nearly half today. Munoz's line about factories is blunt. Once you make a commitment to make a factory, and then you have the factory up and running, there is no way back. A plant is sunk capital. You're not trading in and out of a stock. You're building concrete, steel, and supply chains that will determine your cost structure and strategic options for decades. Now layer in the Georgia story, because it shows how messy execution can get. In his first year, the Trump administration delivered plenty of jolts, as the article puts it. One of them was an immigration raid on the construction site of a battery production plant in Georgia, a joint venture between Hyundai and LG Energy Solution. More than 300 South Koreans, many with specialized know-how, were detained. None were direct Hyundai employees, but they were critical to getting the plant built. They flew back home after release. Munoz says the plant should open in the first half of this year. He says the vast majority of those workers have obtained new visas and are back in Georgia helping finish construction. That's resilience. But it's also a reminder, you are building a key piece of your future cost base inside a political environment you don't control. So how does an outsider CEO try to shape an insider culture to deal with all this? The Journal spends a lot of ink on Munoz's management style. He's worried that Hyundai's hierarchies could shield top executives from the truth or throttle innovation. That's classic large organization disease. People tell the boss what he wants to hear, not what's actually happening. Bad news gets filtered. Execution problems are hidden. His response is to introduce unscripted town halls, which the article calls unusual in South Korea. At first, when question time came, the room went quiet. No one wanted to be the first to speak. So he added an incentive: whoever asks the first question sometimes gets a day off from work. It's a small thing, but it's how you hack culture. You literally pay people in time to speak up. He also coins an internal phrase, PM squared, based on two Korean expressions, pali, meaning quickly, and miri, meaning in advance. The principle is simple. Move fast, but anticipate. Don't just react quickly. Prepare quickly. From a compounding perspective, culture is capital. You can pour $26 billion into US factories and 50,000 NVIDIA chips into your plants. But if the organization can't handle ambiguity, can't speak up about problems, can't adapt, you're just building monuments. Now look at how the market is reading all this. On screen, you're seeing a chart of share price performance over the past 6 months for 4 car makers: Hyundai, GM, Toyota, and Volkswagen. The horizontal axis runs from August 2025 through January 2026. The vertical axis is percentage change from -20 to 5% up to +150. 3 of the lines, GM, Toyota, VW, move in a relatively tight band. They wobble around, maybe up, maybe down, but nothing crazy. Then there's Hyundai. Its line breaks away and runs sharply higher, especially in the last month. That's where the 80% figure shows up. Hyundai stock has risen about 80% in just that past month, coinciding with the Atlas robot reveal and the narrative of a bold, tech-leaning strategy. What that visual is measuring is just stock prices. What it's really showing is investor psychology. The creator of that chart is saying, the market is starting to price Hyundai differently from the rest of the pack. Not as another car company, but as a car plus robots plus AI platform. That's both a blessing and a risk. The blessing is obvious. Your cost of capital improves. You have more currency, equity, and narrative to support big bets. The risk is that you are now being judged on a tech narrative you have not yet fully earned. Atlas doesn't start working in your Georgia Meta plant until 2028. The 50,000 NVIDIA chips have to be integrated and justified. The dual-track EV/hybrid strategy has to produce real, profitable volumes in both the US and China. In other words, the market is pulling forward a lot of future execution into today's price. If you care about value, not just story, you have to ask, how much of this is durable compounding and how much is a robot-fueled sugar high? 3 lessons from this article stand out for long-term owners. First, incentives shape strategy more than slogans do. Munoz can say Hyundai will be a tech company, mobility company, but the real levers are tariffs, demand patterns, and capital budgets. Tariffs squeeze profits and push production into the US. That's why $26 billion is going into American plants, and why the goal is to have 80% of US-sold Hyundais be American-made by 2030, up from nearly half today. Consumer hesitation around pure EVs is why hybrids are being doubled in the US lineup, while China gets 20 new EV models. Those are incentive responses, not branding exercises. Second, scale becomes a disadvantage when it's bolted to rigid culture. Hyundai Kia's global scale puts it third behind Toyota and Volkswagen. That's a strength, until the environment changes faster than the hierarchy can process. Munoz's whole push, unscripted town halls, paid questions, PM squared, is an attempt to unfreeze a big machine. If he fails, the scale will slow adaptation. If he succeeds, that same scale will let Hyundai roll out robots, AI, and dual-track vehicle strategies faster and more broadly than smaller rivals can. Third, success plants the seeds of failure when it's mistaken for inevitability. The article opens by making the case for Munoz's success: million US sales, 40% growth since he arrived, global volumes above 4 million. It also notes that Hyundai has been winning design and quality awards, and that, together with Kia, it holds 10% of the American market. But those very successes can lull a company into thinking it can coast into the future. That's exactly what Munoz is afraid of. That's why he looks at a 22% drop in net income despite record revenue, and doesn't shrug. That's why he's pushing robots, AI chips, and faster factory timelines. He knows that the old sources of advantage, cheap imports, predictable trade rules, slow technology cycles, are eroding. The line that captures his mindset is simple: the sooner the better, so we can enjoy our investments. He wants to pull forward the benefits of these big, irreversible bets before the environment shifts again. That's risky, but standing still is riskier. So what's the core question this Hyundai story is really asking? It's not just, can Hyundai sell more cars? It's, can a non-founder CEO inside a family-controlled Korean industrial group use robots, AI, and US factories to turn a traditional automaker into a durable compounding machine in a world of tariffs and technological shocks? Based solely on what we see here, he's done the first part: sold more cars, impressed the market, jolted the stock. The harder part, proving that these giant, one-way bets on factories, chips, and robots actually translate into superior returns over a decade, is still ahead. And that's the sentence I'd leave you with. When a car company starts wiring billions into robots in US plants, you're no longer just betting on the cars it sells today. You're betting on whether its leadership can make irreversibility compound in your favor. Moving to next title, French firm to cut ICE-linked unit. Capgemini is selling a business unit that accounts for roughly 0.4% of its revenue, because keeping it could cost far more than that in political and reputational damage. That's the core decision buried inside this Wall Street Journal article. A Paris-based consulting and IT company, one of those global vendors that usually tries to stay neutral and serve everyone, has drawn a line, not on price, not on margins, on who it will help a government track. And it's doing that at the exact same time the French state is prohibiting its own agencies from using American video conference platforms, like Zoom and Microsoft Teams, insisting they use a homegrown system called Visio instead. If you care about incentives, moats, and long-term compounding, this is not a side story. This is the new terrain, where geopolitics, ethics, and small contracts can reshape the risk profile of very large companies. Let's start with the central figures. On one side, you have Ayman Ezzat, chief executive of Capgemini. He's the allocator inside the company. He controls the portfolio, which clients to serve, which markets to enter, which units to buy or sell. On the other, you have people like Roland Lescure, France's economy minister, and Sébastien Lecornu, the prime minister. They are allocators too, but of a different kind. They allocate legitimacy. They decide which companies are seen as aligned with sovereign priorities and which ones are not. The article sets the scene. Capgemini has a division in the U.S. that provides consulting services to government agencies. Among its contracts is one worth $365 million with U.S. Immigration and Customs Enforcement, ICE. The purpose of that contract: skip tracing, finding immigrants in the U.S. by using online information and other sources. A nonprofit called Multinationals Observatory brings these contracts to light. This happens against a backdrop where federal immigration officials have shot and killed 2 people in Minnesota. Immigration policy under the Trump administration is under fire. French ministers respond. They say Capgemini should disclose what it is doing for ICE. Lescure explicitly asks the company to shed light in a very transparent manner on its activities and to question the nature of its activities. When your own economy minister is on record telling you to examine what you do for a client, that is governance pressure of the highest order. Ezzat, for his part, says something striking. He claims he only found out about this $365 million contract recently from public sources. The U.S. division that holds it operates autonomously because U.S. law requires that for classified work. In his words, the nature and scope of this work has raised questions compared to what we typically do as a business and technology firm. Right there, you see the gap between the old model and the new reality. What used to work for global IT vendors like Capgemini was a kind of political neutrality. You built local subsidiaries, you met local legal requirements. In the US, that meant firewalls around classified work. Those units were allowed to operate with a lot of autonomy. They could hold clearances, handle sensitive data, deliver whatever the contract required. Corporate in Paris or elsewhere didn't look too closely as long as numbers rolled up cleanly. The incentives were simple: high dollar values, long-term government contracts, sticky, recurring revenue streams. What quietly stopped working was the idea that legal equals socially acceptable, and that what a local unit does can be kept politically separate from the global brand. The ICE contract is a perfect example. On paper, it's just skip tracing, finding people using online and other information sources. That's a classic data and analytics problem, well within the capabilities of a consulting and IT firm. In practice, it's being interpreted by French politicians and the public as participation in an immigration enforcement regime that has just used lethal force in Minnesota. That's not an abstract ethical dilemma. That's a live reputational bomb sitting on Capgemini's balance sheet. From Ezzat's perspective as CEO, the questions become brutally clear. First, can he genuinely say that Capgemini is aligned with its own objectives and values while holding a contract like this? Second, can he exercise the level of control he believes is appropriate over this U.S. classified unit, given the legal restrictions that forced it to operate autonomously? And third, what is the risk that not acting will trigger regulatory or political backlash in his home market, where his brand and his long-term compounding really live? In announcing the sale, Capgemini frames the answer. The company says that customary legal restrictions around classified activities in the U.S. did not allow the group to exercise appropriate control over certain aspects of the operations of this subsidiary to ensure alignment with the group's objectives. That's a careful sentence, but it says a lot. Legal firewalls, which were originally there to protect national security, have become a governance constraint. They prevent the parent from fully knowing, and therefore owning, what is being done in its name. At small scales, you could shrug that off. At a $365 million contract size, with political heat attached, you can't. The economics are almost comically skewed. Capgemini says this division accounts for about 0.4% of global revenue. For a company of its scale, that's a rounding error. The ICE contract itself, while large in absolute dollars, is not a core pillar of the firm's global P&L. The reputational risk, however, is not capped at 0.4%. It attaches to 100% of the brand. It informs how governments in Europe see you. It affects whether French ministries, EU agencies, and other sovereign clients decide you are a trusted partner or a company whose values they doubt. That's a classic asymmetry. Limited upside, uncapped downside. From a capital allocation perspective, selling this unit is less about price and more about risk reduction. You are giving up a small, profitable stream in exchange for removing a large uncertainty from the compounding equation. Now layer in what the French state is doing at the same time. The article notes that France has taken a step to distance itself from US tech companies in another domain, video conferencing. Government agencies are now forbidden from using US services like Zoom or Microsoft Teams. Instead, they are instructed to use Visio, an application developed by the French government. The Prime Minister, Sébastien Lecornu, explains why. He says it is necessary to deploy a single video conference solution controlled by the state based on sovereign technologies. On screen right now, you'd see a photo of Capgemini's glass-fronted headquarters in Paris, with the company's blue logo prominent on the facade. The caption reminds you that Capgemini is a Paris-based consulting and IT firm that will sell the division providing consulting services to U.S. government agencies. The glass building, the logo, the corporate neutrality, it all contrasts with the messy political reality described in the text. What that image really signals is this. Companies like Capgemini operate at the intersection of two sovereign agendas. The US wants control over classified work, France wants control over digital sovereignty. Those agendas can clash inside the same corporate chart. You can see how the incentives have shifted. French ministers are telling Capgemini to be transparent, to question the nature of its ICE work. The French government itself is promoting sovereign technologies over US platforms. The political mood is hostile towards certain U.S. policies. If Capgemini ignores that and hides behind legal autonomy clauses, it risks losing its license to operate in its home political environment. If it overreacts and exits every sensitive U.S. contract, it risks ceding ground to rivals who are willing to take the heat. So ESAT takes a middle path. Sell the one piece where legal restrictions prevent adequate control, and bring the rest of the portfolio into cleaner alignment with group objectives. Let's do a quick decision autopsy on that move. What was expected when they set up this U.S. government division? The expectation was probably secure high-value, long-duration contracts, operate under local law, keep the parent insulated from classified details, book the revenue, move on. It's the standard federated multinational playbook. What actually happened? The political environment changed. ICE became a symbol of controversial immigration enforcement. A specific contract, skip tracing immigrants using data, was surfaced by a watchdog group. French ministers publicly questioned the work. The CEO realized he had less visibility and control than he was comfortable with. The opportunity cost of continuing would be significant. Ongoing political pressure, possible client boycotts, internal employee dissent, and erosion of trust with European governments that might prefer vendors not entangled in this kind of U.S. enforcement work. The hidden trade-off inside selling is that you lose not just the ICE contract, but potentially a beachhead in classified U.S. gov work more broadly. That could make it harder to win future contracts in other, less controversial areas that also require clearances. You're stepping back from a lane that some competitors will gladly occupy. But that's the point. This is a values-constrained optimization, not a pure profit-maximizing one. Now, think about this as an investor in business quality. Capgemini is signaling that it values controllability over raw top line. It wants businesses where the group can exercise appropriate control and ensure alignment with its stated objectives. It is willing to walk away from revenue streams where legal structures make that impossible. From a compounding standpoint, that can be attractive. Companies that know what they will not do often avoid the kind of tail risks that blow up a decade of good execution. At the same time, you have to recognize that politics is now a first-class risk factor for any global IT and consulting vendor. You are not just underwriting project execution. You are underwriting the alignment between your client list and the political expectations of your home state. Right now, France is asserting digital and ethical sovereignty. It is telling agencies to use Visio, not Zoom or Teams. It is telling Capgemini to explain and rethink its ICE work. Tomorrow, it may push for more sovereign clouds, more local data centers, more preference for vendors who align with French and European priorities. For Capgemini, that creates both a threat and a moat. The threat: If you misalign with those priorities, you get frozen out. The moat: if you align well, you become the go-to local champion in a world where global U.S. players face increasing suspicion. 3 lessons emerge from this article for long-term owners. First, incentives shape outcomes faster than contracts do. On paper, the ICE contract is a legal agreement between a U.S. agency and a U.S. division. In practice, the incentives of French politicians, French civil servants, and French public opinion are reshaping that reality. The desire for ethical distance from certain U.S. immigration practices, and for digital sovereignty more broadly, is driving corporate decisions. Second, scale becomes a disadvantage when it obscures control. Capgemini is big enough that a 0.4% revenue unit can be invisible to the top until a nonprofit or a journalist shines a light on it. Legal firewalls add to that opacity. Scale in this case made it possible for something material in reputation terms to be immaterial in financial terms. That's dangerous. The company's response, privileging controllability over size in this one area, is a recognition that unchecked scale at the edge can backfire. Third, success plants the seeds of failure when you mistake being everybody's vendor for being safe. Global IT firms have long prided themselves on serving all sides: U.S. agencies, European agencies, commercial clients everywhere. That ubiquity was seen as a hedge. But as politics hardens and sovereign tech becomes a priority, being everywhere can turn into being caught in the middle. The very success of building an autonomous, cleared U.S. government division able to win a $365 million skip tracing contract is what created the governance gap and the reputational risk that now forces a sale. So what is the core question this Wall Street Journal piece is really asking? It isn't simply, should Capgemini work with ICE? It's, in a world where governments are asserting sovereignty over technology and ethics, can a global consulting firm still run arm's length, opaque units in sensitive domains, and expect the market to treat that as business as usual? Capgemini's own answer, in its actions, is no. And the line to remember is this: when 0.4% of revenue can put your license to operate at risk, the real competitive advantage is knowing which contracts you're willing to lose so the rest of the business can keep compounding. Moving to next title, Powered Land Strategy Accelerates. The Wall Street Journal has a great phrase for this: powered land. That's the strategy a set of infrastructure investors are now chasing, quietly before the rest of the world fully wakes up. Not buying the data centers, not owning the power plants, owning the dirt that already has, or can quickly get, a serious grid connection. This matters because every big AI story, NVIDIA, Meta, hyperscale cloud, ultimately runs into the same physical constraint: electrons on copper. And as grid operators get overwhelmed by new generating sources and new power-hungry projects, the bottleneck shifts from, can you finance the project, to, can you even plug it in? Once that happens, the people who control powered land become the real gatekeepers. Let me lay out who these people are, what they're doing, and why, from an owner's lens, this is a fascinating case of early-stage capital allocation around a new choke point. The central figures in this article are not founders in the classic sense, but they're builders of a different kind. You have firms like Digital Bridge Group, 5 Point Infrastructure, NGP Energy Capital Management, Quinbrook Infrastructure Partners, QIC, and Sandbrook Capital. These are infrastructure investors, pools of capital whose job is to own the boring, essential pieces that keep systems running. You have operating platforms like Cloverleaf Infrastructure, backed by Sandbrook and NGP, whose job is to find specific sites, sign concrete agreements with utilities, and package those locations so a data center developer can move fast. You have Rowan Infrastructure, a Quinbrook portfolio company that doesn't just prepare land, it builds entire data center projects. It's working on campuses in places like Frederick County, Maryland, outside Washington, and Temple, Texas, between Austin and Waco. And you have Renewa, a Houston-based company that takes a more hands-off approach. Buy land near grid connections, lease it to renewable energy developers, and let others handle the build. Around them sit long-term allocators like Ontario's University Pension Plan, UPE, a Canadian pension with about 12.8 billion Canadian dollars under management, roughly 9.4 billion US dollars at the end of 2024. People like James Wong, a senior director for infrastructure at UPP, are looking at these powered land players as vehicles for compounding over decades, not quarters. Notice who's missing from that list. The AI headline names. Oracle and OpenAI show up later, but as customers of the sites, not owners of the dirt. Amazon shows up in a photo. The people quietly building this layer are not the ones getting the front page AI glory. They're the ones monetizing the bottleneck. To see how we got here, you have to understand what used to work. Traditionally, if you wanted to build a power plant or a data center, you followed a fairly standard path. You picked a region where demand existed, you did your site search, you filed interconnection requests with grid operators, you slogged through permitting and environmental. Years later, you got hooked up. Grid operators, for their part, could handle the flow. The number of new large projects was manageable. Transmission lines and substations had slack. Connecting one more plant or one more data center didn't feel like an existential scheduling problem. That model breaks when you combine two forces: an explosion in new generation, especially renewables, and an explosion in new load, especially from hyperscale data centers designed to run AI workloads. The journal describes it simply: a race among large technology companies to create ever more advanced AI tools is fueling an accelerated build-out of sometimes vast data centers to house AI systems and secure the power supplies needed to run them. At the same time, there's a surge in the number of new generating sources and in power-hungry projects. The result: electricity grid operators are overwhelmed, and the time it takes to establish grid connections is lengthening. When connection timelines stretch out, the old game, just file your interconnect request and wait in line, stops working as a value proposition. Time kills IRR. A data center operator or a developer that has to wait years to plug in is carrying land costs, design costs, and opportunity costs with no revenue. That's the inflection point. Enter the powered land strategy. Instead of starting with let's build a huge facility, the new strategy starts with let's find land that already has, or can quickly get, serious grid access. And let's do the hard preliminary work before anyone else does. James Wong at UPP puts it this way: powered land developers can de-risk and front-load some of the work of securing parcels of land that are already connected to the grid and are capable of supporting grid-scale energy loads. That's a mouthful, but it means something very simple. If you own land that already talks to the grid, you've skipped years of pain. Wong adds that sites with existing power access can be delivered much faster, improving project returns. From a compounding perspective, that's everything. Time is the enemy of IRR. If your land package lets a data center operator start generating revenue 2 or 3 years earlier, that time delta is pure value. And if you own the land, you capture a slice of that value through higher sale prices or better lease terms. Let's talk specifics. Cloverleaf Infrastructure, backed by Sandbrook and NGP, is one of the examples in the piece. Last year, it sold sites in Wisconsin for the construction of large installations being developed by Vantage Data Centers. Those installations are for AI services providers Oracle and OpenAI. So the stack looks like this. Cloverleaf finds and prepares the sites. Cloverleaf signs agreements with utilities and power services companies to ensure adequate electricity. That's the grubby, hard-to-replicate work. Understanding where the grid has capacity, negotiating with utilities, aligning on upgrades. Vantage Data Centers comes in as the developer, building large installations. Oracle and OpenAI show up as the demand drivers, big AI workloads that need to live somewhere with a lot of reliable power. On your screen, imagine a map of Wisconsin with 2 or 3 highlighted zones where Cloverleaf has packaged up land. Behind each zone is a stack of signed utility agreements, grid studies, and land parcels stitched together. You never see that stack in the headlines. You just see new Vantage campus serving Oracle and OpenAI. But the value chain starts with the powered land. Rowan Infrastructure is playing a slightly different role. It's not just preparing sites, it's also building entire data center projects. Rowan is working on data center campuses in places like Frederick County, Maryland, outside Washington, D.C., and in Temple, Texas, between Austin and Waco. The article points out what hyperscale really means. These data centers can exceed 1 million square feet and suck up as much as 100 megawatts of power, enough to light a mid-sized city like Baton Rouge, Louisiana. That's not a strip mall server room. That's a new kind of city, built purely for computation, with a power appetite to match. Wong describes the powered land developer's edge this way. They can talk to the power utility and ask, What's your long-term transmission plan? Then they arrive ahead of the transmission lines. That's the key. They aren't just reacting to where the grid is today. They're front-running where the grid will be. Land that looks out in the middle of nowhere today but sits along a planned transmission expansion becomes very valuable when that line goes live. And a hyperscale operator is looking for the next 100-megawatt site. UpT co-invested in Rowan through Quinbrook, backing exactly this sort of advantage. That's a pension fund buying into the idea that powered land prep and aligned development will spit out acceptable steady returns over a long horizon. Then you have Renua, which shows a different way to skin the same cat. Renua is Houston-based. Its managers focus solely on acquiring land near grid connections and leasing it to renewable energy developers. They deliberately don't try to do the whole stack. They don't focus on data center sites because they find that sector more crowded. As of mid-January, Renua had received more than $1.25 billion in commitments from investors like QIC, an Australian investment firm, and the Canadian pension manager CDPQ, plus others. QIC first backed Renua in 2210. So again, look at the capital structure. Long-dated, patient capital, pensions, big institutions, funding a company whose only job is to own land near grid nodes and lease it to people building renewable projects. Some of those projects, as the article notes, end up serving data centers anyway. The electrons don't care. They just flow. Arash Shojaye, a partner at QIC, puts it bluntly. The powered land grab happening with data centers is exactly the same as the one happening in renewable energy. The common element is scarcity value in parcels of land that are connected to the electricity grid. The only difference is that the data center part is in greater public focus. That's a nice way of saying the headlines are about AI, but the trade is the same one infra investors have been chasing in renewables for years. Own the scarce nodal real estate. The journal gives you one powerful visual that ties this together. On screen, you see a photograph of a data center being built by Amazon. It sits next to the Susquehanna nuclear power plant in Berwick, Pennsylvania. In the image, you have the massive concrete cooling towers and industrial bulk of the nuclear plant on one side, and, right next to it, the emerging boxy form of a data center facility. What's being measured in that image is proximity. Compute right next to generation. What the article is really saying with that picture is that powered land is often about adjacency, being close enough to a big, steady power source or a major grid node that you can secure a dense, reliable feed. Most people look at that picture and see Amazon likes cheap nuclear power. As investors, we should see someone controlled that parcel that allowed Amazon to build next to that plant, and that someone captured the adjacency premium. Now, it's important to stress, this is not a risk-free arbitrage. The article is clear about the risks. Powered land strategies come with the complexity of meshing local generating stations with the electric grid. That means technical issues, interconnection studies, protection systems, voltage issues. If you pick a site and underestimate how hard it will be to mesh with the grid, your timeline slips and your returns erode. Rising land prices are another risk. As more investors pile into the powered land game, the very parcels you're trying to collect become more expensive. If you're paying bubble prices for land just because it's near a substation, you can easily overpay and wipe out the advantage. Then there's community resistance, spurred by rising electricity bills. Local opposition to new projects, whether data centers or generation, can delay or derail development. If the community sees your powered land parcel as the reason their view is getting spoiled, or their bills are climbing, the politics can turn hard. So this is not free money. It's early-stage industrial infrastructure with all the usual frictions, but it's also a classic illustration of how incentives and capital allocation shift when a new bottleneck appears. The AI boom has made data centers visible. Hyperscale facilities drawing 100 megawatts look outsized and new. But the underlying game, control the interface between projects and the grid, is old. In the renewables world, developers spent years learning that the true scarcity was not wind or sun, but interconnection capacity. Now, data center developers are learning the same lesson. Let me pull out 3 lessons that matter for long-term owners. First, incentives shape where the real money gets made. AI hype pushes investors toward model makers, chip designers, cloud providers. That's the visible stack. But the article shows the incentive shift. Grid operators are overwhelmed, connection queues are long, and time to plug in is the new pain point. Infrastructure investors see that and move where the incentive is strongest: the front-end work of securing grid-connected land. If a data center operator will pay a premium for a site that's ready to go, the powered land developer can clip a healthy return for doing unpopular, complex early work. Second, scale becomes a disadvantage if you show up too late to the bottleneck. Big tech companies are racing to build ever more advanced AI tools, but they are not nimble when it comes to land. They move slowly, publicly, with brand constraints and internal politics. By the time they announce a big campus, powered land players have often already stitched up the best parcels along the relevant grid corridors. The same is true in renewables. The largest utilities and developers can sometimes be slower to spot and secure niche nodal opportunities. Smaller, focused, powered land platforms can get there first, then sell or lease into the big players' demand. Third, success plants the seeds of failure when everyone chases the same visible prize. Right now, the visible prize is AI data centers. That's where the press is, where the political debate is, where companies are putting out flashy press releases. If you assume that's where your edge is, you'll pile into the same crowded markets. Northern Virginia, major cloud hubs, everyone bidding up the same parcels. The smarter powered land strategies in this article are doing something different. They are finding less crowded regions where plans have been made for new electricity transmission lines and substations. They are arriving ahead of the lines, not behind them. Renewa doesn't even focus on data center sites because it sees that sector as more crowded. It sticks to renewables and lets those projects sometimes feed data centers indirectly. That's success, understanding the scarcity without falling for the obvious noisy part of the story. So what's the core question this Wall Street Journal article is really asking? Not how many data centers will we need, or is AI a bubble? The real question is, in a world where power and grid access are the new choke points, do you want to own the things that need permission to plug in, or the land that everyone has to pass through to get to the plug? Powered land investors have answered that for themselves. They're raising billions, signing utility deals, and front-running transmission lines on the bet that time, electrons, and scarcity will do the compounding for them. And the line I'd leave you with is this: in the AI gold rush, the quiet fortunes won't just belong to the chip makers. They'll belong to the people who bought the ground under the substation while everyone else was still staring at the cloud. Moving to next title, labor shortage hits broadband boom. We just don't have the people to do the work. That one sentence, from a fiber build manager in rural Arizona, might be the most important line in the Wall Street Journal's piece on the broadband boom. Because it exposes something most investors don't want to think about. You can pour billions into AI, cloud, and broadband subsidies, but none of it compounds if you can't find enough people willing and able to run a drill, hang cable, and fuse glass. This story is from the Wall Street Journal, and it looks at the broadband surge as a labor problem, not a technology problem. It's really about a human bottleneck sitting right between federal grants on one side and AI data centers on the other. The central figures here are the people who build the invisible network we all rely on and the small company operators reshaping incentives on the ground. Start with Sammy Collins in Egar, Arizona. Picture him at a work site in Apache County, hands on the controls of a 15,000-pound directional drill. He's boring a precise tunnel through the soil for future fiber optic lines. Around him, about 40 other crew members spread out across this rural corner of northeast Arizona, digging ditches, feeding cable through conduit, hanging fiber on utility poles. 6 months ago, Collins was working at an addiction treatment facility. In half a year on this crew, he's notched 2 promotions and boosted his pay by more than 22%. Experienced drillers in this world can make anything from the high 20s to the mid-40s per hour. That is what a real-time repricing of labor looks like. Then there's Kyle Browdy at JKL Associates, a subsidiary of utility construction contractor Push. He manages fiber build projects and puts it simply, we just don't have the people to do the work. His list of constrained roles is specific: drillers, foremen, splicers, area linemen. If you can do those jobs well, you are scarce. Over him, as allocator, sits Push's president, Chase Lapsinski. He's the one deciding to raise hourly wages for fiber crews by 5 to 8% in each of the past several years, and he says he expects pay to rise even faster from here. He's also the one seeing an unprecedented rush of clients trying to lock in contracts early, before wages climb further. In Missouri, Steve Sellenreek runs Sellenreek Construction, another fiber contractor. Entry-level workers there made about $60,000 last year, including overtime. In the first 3 years, that can jump 25 to 30%. Site superintendents can make 6 figures. That pay ladder is not an abstract chart. It's a direct response to scarcity. And then you have people like Cesar Ruiz, president and CEO of Learning Alliance in Tampa, Florida, who's trying to build a training pipeline that telecom never built for itself. His organization runs a 6 to 8 week boot camp funded by military benefits and corporate donations to train students to install fiber. The 2025 graduates started at about $26 an hour plus overtime. That starting pay is up roughly 13% in 2 years. Those are the operators. They're not writing white papers about AI. They're writing checks to keep crews from walking down the road to a competitor. For a long time, what worked in telecom infrastructure was incrementalism. Carriers deployed fiber slowly. Contractors could manage with the crews they had. Training was mostly informal. You joined as a helper, you learned on the job. You moved up. Demand for new lines was steady but not explosive. That model quietly broke when 3 forces converged. First, the federal government unleashed billions of dollars in broadband grants. The result, fiber cables were laid at a record number of homes last year. There's a chart in the article that shows new homes reached by fiber cables from fiscal year 2016 to 2025. The bars start low, just a couple of million homes, and rise steadily to around 10 to 12 million homes reached in 2025. On screen, you'd see a rising staircase of bars labeled 2016, 2020, 2025, climbing higher and higher. That's the visual representation of policy hitting the ground. Second, technology companies' appetite for data centers exploded. AI workloads and cloud services started demanding dense, reliable fiber everywhere. Suddenly, the same crews that used to serve mostly consumer buildouts were being pulled into the orbit of hyperscale compute. Third, the workforce demographic clock kept ticking. A 2024 report by the Fiber Broadband Association and the Power and Communication Contractors Association projected that between 2025 and 2032, demand would create 58,000 new jobs in the fiber field. Over the same period, roughly 120,000 existing workers are expected to leave the field, mainly through retirement. Net result, a projected shortage of 178,000 workers. So you have record demand on one side of the ledger, and a shrinking, aging workforce on the other. That's the quiet break. The inflection point is where those two lines cross. On the demand curve, you have record numbers of homes passed with fiber, data center projects stacking up, governments publicly committed to nationwide high-speed internet. On the supply curve, you have crews that can't hire fast enough, workers being poached by competitors, a looming retirement wave. Contractors and analysts in the story go as far as to say that our AI future might take longer to achieve, and a goal of nationwide high-speed internet could remain out of reach. That's not hyperbole. That's a time and materials reality. Follow the money, and you see how capital allocation is shifting in response. The Bureau of Labor Statistics reports that telecommunications line installers and repairers had annual median wages of $70,500 for the year ended May 2024. That number doesn't include overtime. With overtime, many of these workers clear that by a wide margin. At Sellenreek, new fiber workers earn around $60,000 including overtime. Then you apply that 25 to 30% jump over the next 3 years, and you're staring at mid-70s or higher. Site superintendents hitting 6 figures are the top of that ladder. Push has been raising hourly wages by 5 to 8% every year. That's not occasional. That's planned, repeated wage inflation. Those increases are put in place within 2 to 4 months, fast enough that the crews feel it. Learning Alliance's starting rate for its fiber installer graduates has climbed from around $23 an hour to $26 in 2 years, a 13% bump. If you look at this as an economist, you say wages are clearing the market. If you look at it as an owner, you say my labor costs are structurally rising. My bids must reflect that. My capital allocation must adapt. But the interesting part is how operators are choosing to respond. Someone like Lapsinski at Push is not just paying more, he's actively building future supply. He hosts hands-on skill days for high school students in Wisconsin. Teens come in, see and touch the equipment, get a sense of what the work is. He hires from everywhere: farmers, former inmates, white-collar workers tired of office life. For him, those groups are not non-traditional hires. They're the pipeline. That's a business decision. It takes time and money to run skill days, to take a chance on someone with no fiber experience, to train them up to the point where they can run a drill or splice cable without supervision. The alternative is worse: turning down contracts because you don't have the crews. And you can see wages reshaping behavior on the worker side. Take Mitch Grant, a fiber splicer with K&S Communications. He used to do cell tower work. 4 years ago, he left tower work to manage fiber crews. Then he saw how much a good splicer can make, sometimes upward of $30 per splice, on projects like the one in Springerville, Arizona. And he moved into that specialty full-time. His work is delicate. He cleaves each strand of fiber optic cable to create a clean edge, then uses a fusion splicer to join the hair-thin filaments. Those glass strands carry digital data at the speed of light. If they're misaligned by a fraction, or if there's a speck of oil from his fingers, the splice fails. When you first start doing it, it's like, "How can you possibly do it?" he says. But then you get muscle memory. On screen, imagine a close-up shot. Grant sitting at a small bench, a fiber splicing machine in front of him, gloved hands holding a tiny strand of fiber, a monitor showing 2 microscopic ends lining up before a spark seals them. The caption: "A fiber splicer carefully fuses hair-thin filaments that carry data at the speed of light." That image makes visible the invisible skill premium the article is talking about. Now, productivity is not just about pay. It's also about conditions. Fiber crews often work 10+ hours a day, outdoors, in nearly all weather. They may relocate for months to wherever the projects are. In parts of the country, winter slows everything down because drilling through snow and frozen ground is harder, riskier, or simply uneconomical. There's a line about Springerville, Arizona, where most locals don't yet have high-speed fiber internet. Grant says they're eager to get connected, so eager they stop him while he's working and ask for updates. The service, provided by ComNet's Ethos Broadband, is expected to be live within a couple of months. That tells you something crucial. Demand at the edge is not abstract. People in small towns want real broadband. They are watching this small number of technicians as their direct interface with the future. Skilled trades across the board, auto repair, electrical work, construction, are facing workforce pinches. The article notes that fiber doesn't yet have the same entrenched training pipeline those older trades enjoy. That absence is itself a capital allocation error, years in the making. Telecom and contractors let the skill pipeline stay ad hoc, then got blindsided when demand spiked. That's where the quote from Lapsinski lands hardest. AI isn't going to replace this. It will accelerate and support some of it, but it's not going to go out and dig the hole. From a business quality perspective, this is a good test of who understands reality versus who is just repeating buzzwords. AI can optimize routing, reduce truck rolls, improve network design, but the last 10 feet of conduit, the last splice in the rain, is still manual. Now look again at the fiber chart. The horizontal axis is time. Fiscal 2016, 2020, 2025. The vertical axis is millions of new homes reached by fiber cables. The bars climb from low single digits to around 10 to 12 million in 2025. At a glance, it looks like a success story. The country is catching up. What most people miss is that the same chart is also a stress diagram. As each bar climbs, it represents not just glass and plastic, but thousands of additional splices, thousands of additional pole climbs, thousands of additional drill runs. The steeper that curve gets, the more we are leaning on a workforce that the article tells you is both aging and undersized. The risk is straightforward. If the 178,000 worker gap doesn't close, that curve will flatten. Not because the money stopped, but because the bodies did. 3 lessons stand out for long-term owners. First, incentives shape outcomes far more than slogans. It's easy to say nationwide broadband and AI for everyone. The real incentive signals are 70,000 plus median wages, 5 to 8% annual raises for crews, 60,000 starting packages, $30 per splice for highly skilled work. Those are strong enough incentives that people like Collins and Grant change careers. If you want the build-out to continue, you must keep those incentives attractive. If you try to squeeze them, the workers will walk. Second, scale becomes a disadvantage if you ignore the non-scalable part of the system. Big tech, big carriers, big government can commit billions. They can set ambitious targets, plaster maps with colored coverage plans. But the actual work scales only as fast as you can train and retain human beings willing to stand outside for 10 hours in all weather. Companies like Push and Sell and Reek that understand this are scaling training and wages. Those that assume labor will just show up will find themselves with stranded capital, funded projects, empty trenches. Third, success plants the seeds of failure when you build on a thin human foundation. The very success of broadband policy, the record number of homes passed, the ambitious timelines, created a situation where almost any shock to the labor base becomes systemic risk. A wave of retirements, a competing boom in some other trade, or simply burnout can derail the plan. The article hints at this when it says, fiber doesn't have the robust training pipeline that auto repair or electrical power has built over decades. That's the seed. If it's not fixed, a lot of the current success will prove fragile. So what's the core question this Wall Street Journal piece is really asking? It's not, will we spend enough on broadband? We already are. It's, will we build a labor market and a training ecosystem strong enough that those billions don't get stuck at the edge of a shovel? Because at the end of the day, for all the big talk about AI and the cloud, the sentence that matters is this. If you can't find enough people to pull fiber through the ground, the real speed limit on the digital economy won't be compute. It'll be the number of hands on a drill in places like Apache County. Now, towards last article, the vibe in the crypto market right now. Stay alive. It's a mess out there. The vibe right now is stay alive. That's not a hedge fund CIO talking about distressed credit. That's a 32-year-old car salesman in Chicago describing the crypto market in the Wall Street Journal. And if you read the whole piece, you see a pattern. The people who thought 2025 would be 2021 all over again are now discovering what it feels like when the party's over, but the leverage and the promises are still there. This is a story about expectations, incentives, and what happens when an asset class that sold itself as an inflation hedge and a debasement trade underperforms even as stocks keep ripping and the dollar weakens. The central figures here aren't founders, they're allocators of a different sort. Individuals deciding how much of their net worth to leave in a market that stopped rewarding risk. And in the background, you have Strategy, Michael Saylor's Bitcoin treasury vehicle, sitting as a kind of symbolic benchmark for everyone else's pain. Let's name the characters. First, there's Michael Saylor and his company, Strategy. They're not interviewed directly in this piece, but they're present as a reference point. The article notes that Bitcoin briefly dipped below the average price Strategy has paid for its Bitcoin holdings. That means that for a moment, the poster child of put your corporate treasury into BTC was underwater on its core trade. That's an important psychological anchor for the entire space. Then there's Gennaro Salemme, 32. A car salesman in Chicago with a $200,000 portfolio, about 40% of which is still in crypto, Ether, XRP, and Bitcoin ETFs. He bought Bitcoin 9 years ago at $3,000. He says he's 100% still bullish long term, but you can feel the strain in his words. Everyone wants to leave when things go south. A lot of this is emotionally driven. His stated goal in the current environment is simple: stay alive. You have Louis Carr, a 19-year-old college student in Texas who sold gaming consoles on Facebook Marketplace to fund his crypto investments. A year ago, he felt like you couldn't lose money. Now he keeps about a quarter of his approximately $6,000 portfolio in crypto and still puts roughly $50 a week into Bitcoin, Ether, and XRP. But he calls crypto a total gamble and says, "I think everybody realizes that." And you have Will Warden, a 44-year-old commercial real estate broker. He watched crypto from the sidelines for years, then jumped in after Donald Trump took office, expecting that by late spring or summer of 2025, he would have a huge return. That didn't happen. He's decided to ride out the downturn. His father and brother, they've cashed out. His summary of sentiment: a lot of people are exhausted, or irritated, or angry. Those are the allocators this cycle, not the venture funds. The individuals. They're the ones absorbing the volatility and the drawdowns while equities print new highs. To understand how we got here, you have to look at what worked last time. Crypto's last big run sold three stories. First, digital gold, a hedge against inflation, against debasement of the dollar. Second, a growth lever, tokens as high beta tech. If the future is digital, these assets go up faster than everything else. Third, regulatory normalization, spot Bitcoin ETFs, institutional custody, Wall Street coming in. By early 2025, those narratives felt vindicated. Major Wall Street firms had launched spot Bitcoin ETFs. Donald Trump was back in the White House promising to turn America into a Bitcoin superpower. He later signed a law regulating stablecoins, which raised hopes that clearer rules would boost the crypto industry. For people like Carr, it was almost like it was 2021 all over again. He describes it in childlike terms, like you couldn't lose money. What quietly broke was the assumption that those conditions would automatically translate into another one-way upcycle. The article notes that after rallying in early 2025, digital assets surrendered much of the spotlight to the artificial intelligence race. Capital that might have gone into tokens flooded into AI plays instead, powering a third straight year of double-digit gains in stocks. Equities, especially big tech, were the risk asset of choice. Crypto was no longer the coolest trade in the room. At the same time, the macro backdrop changed in ways that cut both ways. The dollar weakened, which traditionally should have helped alternative assets in the so-called debasement trade. Investors started to bet the economy would keep growing. Stocks hovered near records. The gains broadened beyond just mega-cap tech. In other words, risk appetite returned. Just not into crypto. Layer on top a weakening job market and escalating geopolitical tensions, and you have a risk landscape where people are more selective about where they deploy their high beta chips. Then, instead of a clean regulatory tailwind, you got something more ambiguous. Trump's stablecoin law was a positive step, clearer rules for a slice of the market. But around the same time, you had rising rates pressure, political noise, and now a Federal Reserve Chair nominee, Kevin Warsh, who has been supportive of Bitcoin rhetorically in the past, but is seen by some investors as potentially tougher on monetary policy. The article makes that tension clear. Some traders hope Warsh's supportive comments on Bitcoin mean good things. Others fear tighter policy that could hurt risk assets, including crypto. As all this unfolded, the price action turned. Bitcoin hit a record in October. From that peak through Friday, it shed about 1/3 of its value, and it sank further on Saturday. Ether and other tokens fell as well. If you pull up the chart in the article, you see a 6-month performance graph. On screen, imagine a line chart from August 2025 to January 2026. 3 colored lines. One for the S&P 500, meandering upward, perhaps up low double digits. One for Bitcoin, swinging higher into October, then sliding down roughly minus 30% over 6 months. One for Ether, also down, maybe the mid-20% range. The vertical axis shows 30% to plus 30%. The S&P line hovers in the positive teens. Bitcoin and Ether end near the bottom of the range. The caption, cryptocurrency and index performance past 6 months. Visually, it's brutal. Stocks at or near highs, crypto in drawdown. This directly undercuts the idea that crypto is a must-own high-beta expression of risk appetite or dollar weakness. The allocation response has been cautious to negative. The article says investors have pulled a net $227 million out of spot Bitcoin ETFs through Jan. 28, based on Morningstar direct data. That's not a tidal wave, but it's not a vote of confidence either. For an instrument that was supposed to attract persistent inflows as digital gold, net outflows are a yellow flag. You also see allocation decisions at the individual level. Salame still keeps about 40% of his portfolio in crypto, but he describes the environment as emotionally driven. He feels the urge to sell when everyone wants to leave. His risk now is not just price, it's behavioral. How long can he watch drawdowns while other assets do better? Carr, the 19-year-old, still DCAs, $50 a week, but he now calls crypto a total gamble. That's a big shift in framing. In his mind, this is no longer an inevitable path to wealth. It's a lottery ticket he still feels compelled to buy. Warden saw his huge return thesis for 2025 fail to materialize. He holds, but his family sells. That's intra-household capital allocation. Some decide the thesis is broken, others cling to it. From a capital allocation lens, the system is moving from all in on the dream to triage and survival. The article points out that some traders are still hoping for relief. A supportive Fed chair, a good earnings print from Strategy, big tech names like Palantir, Amazon, and AMD delivering strong results, a benign jobs report. The implication is maybe a good macro week will bring some risk appetite back into tokens. But note the sequence. Crypto is now waiting on TradFi earnings and macro data. That's the opposite of the crypto is uncorrelated story. Let's talk about the psychological side, because the journal spends time on it. Salemi describes it as a mess and says the vibe is stay alive. That's pure risk management talk. He's not fantasizing about 10x. He's trying not to blow up. He also notes the isolation. Holding on is excruciating when everyone else is abandoning ship. That's what happens at the back end of a speculative cycle. People who got in late want out. People who've been in for years wrestle with sunk cost beliefs. Warden says people are exhausted, or irritated, or angry. That's emotional capital burned, not just financial. When you burn emotional capital, it's harder to attract fresh flows later, even if the thesis improves. On screen, you see another chart, this time comparing 6-month total returns for cruise stocks: Royal Caribbean, Norwegian, Carnival, and Viking. 3 are negative double digits. Viking is positive. That's a separate article on the page, but it's instructive. Sectors go in and out of favor. Capital rotates. Cruise stocks got a cabin upgrade after strong results. Crypto, by contrast, is in the opposite emotional state. No earnings to surprise to the upside. Just prices sliding. Now the reality check. The article spells out the contradiction. Stocks are near record highs. Gains are broadening. The dollar has weakened, pushing some investors toward alternative assets in the debasement trade. If your thesis was crypto will shine when the dollar weakens and stocks wobble, this is not your setup. The debasement trade is materializing in narratives, but the capital is going into other alternatives. Gold maybe? Or non-US assets, not necessarily into Bitcoin. And if your thesis was regulation plus Wall Street adoption equals structural demand, the ETF outflow figure and the sentiment quotes are not comforting. 3 lessons for long-term owners come out of this. First, incentives shape flows more than narratives. The narrative last year was ETFs, Trump, stablecoin law, Bitcoin superpower. The incentives this year are AI equities are delivering, broader stocks are up, crypto is causing stress. A rational capital allocator goes where risk-adjusted returns look better, not where the most inspiring manifesto was written. That's why money rotated from tokens into AI stocks. Second, scale becomes a disadvantage when your biggest evangelists are underwater. Strategy and Saylor played the role of institutional anchor for the Bitcoiner story. When price dips below their average cost, that anchor becomes a millstone. It doesn't mean they'll sell, it means the psychological they can't lose aura is gone. For late cycle entrants, knowing that even the hardcore treasury buyer is temporarily in the red changes the risk calculus. Third, success plants the seeds of failure when it convinces retail that you can't lose money. Carr's line about it feeling like 2021 all over again is the classic tell. When a trade feels like you can't lose, people lever up emotionally and financially. That's exactly when the risk is highest. The investors in this article are now dealing with that hangover. Some are staying in, but reframing their objective to survival. Some are still DCAing but calling it a gamble. Some are cashing out. So what's the real question this Wall Street Journal piece is asking? It isn't, will Bitcoin go up again? It's, can this market transition from being a momentum-fueled casino, where retail believes it can't lose, to a genuinely investable asset class whose holders can sit through drawdowns without needing to tell themselves fairy tales? Right now, the vibe the article captures is clear. It's not about getting rich quick anymore. It's about not getting wiped out. And the sentence worth remembering is this. When the people who once believed crypto was a sure thing start saying stay alive, you're no longer just pricing tokens, you're repricing the entire psychology that drove the last bull market. This is Avi. Like and subscribe. On to the next.